On July 11, 2025, President Donald Trump shocked the world by announcing, via social media, a sweeping 35% tariff on Canadian imports, effective August 1st. The move escalated trade tensions with one of America's closest allies, leaving businesses and officials scrambling for answers. This wasn't the first tariff. Trump had already imposed a 25% blanket tariff in March, but this hike signaled a hardening stance. The abrupt announcement left industries with little time to adapt, evoking memories of past trade wars but with even higher stakes. Supporters hailed the move as job protection. Critics warned of economic fallout and chaos for cross-border supply chains. Details were scarce, fueling uncertainty about which goods would be hit and whether exemptions would apply. The tariff was framed as a pillar of the president's America First agenda, blending economic and diplomatic pressure. The stage was set for a high-stakes confrontation that could upend North American trade and ripple through the global economy. The White House justified the 35% tariff as a defense of American jobs, a core America First promise. But the timing was no coincidence. Canada had just backed Palestinian statehood at the UN, and Trump openly linked the tariff to this move. Trade became a weapon, punishing a G7 ally for its foreign policy stance, a sharp break from traditional diplomacy. The tariff followed a pattern. Just weeks earlier, Canada dropped a digital tax after US threats. Critics accused Trump of using tariffs to settle political scores, destabilizing international relations. On the day tariffs took effect, Trump fired the Bureau of Labor Statistics commissioner, deepening the sense of institutional upheaval. The administration's willingness to upend norms left allies and markets on edge. Despite the headline, the 35% tariff didn't hit all Canadian goods. About 95% of exports remained exempt under the USMCA. The hardest hit were products failing strict North American content rules, like electronics and machinery, often produced by smaller firms. These businesses faced a bureaucratic nightmare to prove compliance, while others, like agriculture and energy, were largely shielded. The new tariff stacked atop existing duties: steel, aluminum, and now copper-faced crushing rates. The result, a two-tiered reality where some sectors carried on, but manufacturers faced existential threats. The Bank of Canada warned these tariffs were unsustainable for affected industries. The uneven impact deepened economic uncertainty across the border. Financial markets reacted instantly. U.S. stock indices tumbled as investors feared supply chain chaos and rising costs. The Dow, S&P 500, and NASDAQ all dropped sharply on August 1st, reflecting anxiety over corporate profits and economic growth. Businesses on both sides of the border scrambled to reassess supply chains and pricing, especially in the auto sector. The increased costs threatened to squeeze margins or be passed to consumers. American firms relying on Canadian materials faced higher input costs, undermining competitiveness. Industry groups warned the tariffs would hurt U.S. workers and consumers, contradicting the America First narrative. Political turmoil, like the firing of key officials, added to market instability. The result, a volatile, unpredictable business climate. Canada launched emergency talks with Washington, but hopes for a quick resolution were slim given the political backdrop. Canadian leaders faced a dilemma: defend economic interests or resist U.S. pressure on foreign policy. The tariffs were part of a global U.S. offensive. Brazil, Switzerland, and others faced new duties, while Mexico's hikes were paused. The world watched the U.S.-Canada standoff as a test of Trump's second-term strategy. Fears grew that the post-war trading order was unraveling, prompting countries to consider WTO action or new alliances. Canada's dispute was just one front in a broader realignment of global trade. Ongoing U.S.-China negotiations and simultaneous disputes created a tangled web of uncertainty. Nations everywhere began recalibrating their economic partnerships in response to America's protectionist turn. The 35% tariff pushed the world toward a dangerous trade war, risking tit-for-tat retaliation and supply chain breakdowns. Both U.S. and Canadian businesses faced higher costs, job losses, and inflation as tariffs filtered down to consumers. Everyday goods, from food to building materials, became more expensive, fueling cost-of-living pressures. The use of tariffs as political punishment undermined decades of rules-based global commerce. Other countries could follow suit, fragmenting the world economy into rival blocs. The future is uncertain. Negotiations might de-escalate tensions, or the conflict could spiral, drawing in more nations. This moment forces a reckoning with the risks of economic interdependence. The architecture of global trade stands at a crossroads with consequences that could last for years.